So, what's the first calculation? Something times 30 or 38 or
The taxable dividend times 38 1/3%.
so lesser of taxable dividend of 50,000 times what now?
38 1/3.
And how much is that?
19,166.
19,166?
Yep.
Yeah, I'll buy that. Lesser of that and
RDTOH of 80,000.
don't have to multiply that times something? Need a lifeline? Correct. Remember, we're only multiplying one number by something or other. It's this, we multiply the taxable dividend times 38 1/3%, and it's the lesser of that and $80,000. Period. No multiplication here at all. We've done all our work down here. All we need to do now is compare it to this. Accountants, they all get the calculators out there, multiplying everything times whatever. No, lawyers, smarter than that. Multiply this thing, and that's it. Therefore, the lesser of 19,000 and 80,000, our dividend refund is 19,166. In my paper, right here, I got the wrong rate. I myself got the wrong rate. 38 1/3 is correct. I messed up. That would cost me a mark. And I'm explaining to you how easy it is to mess these things up, hence partly why our exams are open book exams. I myself messed this up. 38 1/3% is correct. Thank you. Now, in questions, exam questions, I'll say this rate, that rate, this rate, that rate, like 13%, 27%, 50 2/3%, et cetera, et cetera. But I won't give you 38 1/3, and I won't give you 30 2/3. So you'll have to know that yourself. So 30 2/3 is how much of the AII goes into here, and 38 1/3 is this lesser of deal to tell us how much our dividend refund is. 38 1/3 times the taxable dividend. Okay. Don't have anything else to say about SIB income and the difference in taxation between that and active business income, and what happens as SIB gets flowed out, RDTOH, et cetera, capital gain, capital limit account. There's nothing else to say about that. I'm going to turn now to dividends, and we'll do some examples of that, about which Leo introduced you last week also. Any questions before I move on? This is go slow day. This is a day when, honestly, if you have a scintilla of unsureness before we go on to, yes?
I'm not sure if this question makes sense, but if the RDTOH is the lesser number and that's what you're using for the dividend refund, does that mean that money is coming out of, like, is that an account that it leaves and then the next year it's back to zero kind of thing?
Excellent question. I'm going to repeat in case the camera didn't hear it. If we're paying out any of these things, then the thing gets reduced. Like, for example, if RDTOH is $100 and we get a dividend refund of $100, does that mean that it's zero going forward? Yes. All these things, when we start using them, we deduct from them how much we've used. Excellent question. Yes?
So then in that case, are there instances where you would kind of want to rig it so that you're not using the RDTOH so you could save it for the future or something like that?
Once I know that I've got again, the question is, if you've got a RDTOH, is there any advantage to saving it for the future or something like that? Short answer, no. If you decide that you're going to take a taxable dividend, a dividend that's bigger than what you've got in here, you might as well, the corporation might as well enjoy a dividend refund. Oh, and by the way, if you've got GRIP and you can use that as well. Any others? Excellent questions, thank you.
In a situation like the example we just did, where the dividend refund was the lesser of, and there was the 50,000 taxable dividend, it came from that, do we reduce RDTOH then at all?
Yes. In a situation, actually the camera probably heard you that time. We're claiming a dividend refund, which was 50,000 times 30 1/3%. Yes, that would reduce, and what is the amount again?
It was 19,166.
Our RDTOH going forward is whatever that is.
Oh.
Approximately that much.
Perfect, thanks.
So then, next time we do this calculation, it'll be lesser of 38 2/3, whatever that year's taxable dividend is, and $61,000. Now let's say we the next taxable dividend is $1 million. It's infinity dollars. The dividend refund will be the lesser of, which is this, and then it'll be zero after that. That's okay. Any others? Like I say, this is go slow day.
So because the corporation just got a dividend refund of approximately $20,000, it's now got $20,000 in cash, can it just issue another dividend?
No,
And then claim another?
it's like a perpetual motion machine.
What, that's what I'm wondering.
The best way I can say no is to go back to page 599, 499 rather. And the question in case Cameron didn't hear it is, so a corporation just got a dividend refund. That means it's got more cash coming from CRA. Does that mean it can declare another dividend? Why not? Because, I mean, you got cash and then, more cash coming in. And the answer is that when the amount of the dividend was decided on in the first place, somebody said, I want to take into account how much cash we're going to have after the dividend refund comes in, which is kind of the same as this page 499 question or example. Somebody said, hey, we've only got right now in the bank $493, but I know that we've got 307 sitting out there, being 1,000 times 30 2/3%. That would give us $800 in total. Let's pay out a dividend of $800. That's the usual scenario, actually. Any others? By the way, if you just step back for a second and look at the course in sort of a meta way, we're talking about the tax rates applicable to corporations. And as you're finding out, there's like 3 or 4 different kinds of income, and each of them has its own thing. So active business income actually is the simplest. It's either high rate or low rate, depending on whether we get to claim the small business deduction. And then there's rules that say, well, hang on, you have to share the small business deduction, and if your company's too big, you can't claim it. Or if you've got too much investment income, you can't claim as much as you might like. So there's that. And then the only other kinds of income are SIB income and taxable capital gains, which are sort of related, total of which is aggregate investment income. And that's all this page 499 scenario, where you pay tax, then there's a refundable tax and whatever. And 1/2 of capital gains get paid out tax-free. And then the only thing that's left is dividend income, so a corporation that owns shares of another corporation. After we finish talking about this, we'll talk a bit about, and only a bit I promise you, into how income gets calculated. And parts of that are very important to lawyers. And then we're going to sort of talk about what is the planning that we can do with all this stuff. So how can we take money out of a corporation, for example? And the part that really is very exciting is sales of businesses or sales of shares of corporations, where we have ginormous dollars and a lot of emotion on the line. People are selling their businesses, and it's the largest transaction they'll ever do in their whole life. And lawyer, can you please help me plan to minimize the tax, et cetera, et cetera. So just giving you some idea of sort of where we're headed. I invest in public corporations, and I have heard, so this is public corporations that I normally invest in. I have heard that instead of investing in them myself, I can create a corporation and have my corporation invest in them. Like that. If I do the investing, back to page 428, please. If I do the investing, I have to pay about 35% tax on my dividends, which are eligible dividends, because in the public corporation paid general rate tax of approximately 27%. So then I pay 35% on my eligible dividends coming out. You okay so far? And somebody told me about the existence of 112 bracket 1 of the Income Tax Act. Please go to that. 112 bracket 1. And that is the one that says where a corporation has received a taxable dividend, you know what that is. Dividend is not a capital dividend. From a taxable Canadian corporation, which, by the way, is a corporation that's not a non-profit nor a registered charity, so like just about any corporation you can think of. In this case, Shopify. Shopify. Earn some dividends from Shopify. Because this corporation owns this much of Shopify and received a dividend of $10,000. And I, knowing only half the story, am thinking, well, this corporation included the $10,000 in its income for Part 1 tax purposes, and they got a deduction of $10,000, leaving zero taxable income for Part 1 tax purposes. That's pretty awesome, because I, as an individual shareholder, don't have access to anything as powerful as 112 bracket 1. I have to include my dividend in my income. Income Tax Act says, well, That's not acceptable. You, Dan, would have paid 35% personal tax, federal and provincial combined. We hate what you've done so much that we're gonna make your corporation pay, ready for this, 38 1/3%. Tax on this, not tax under part 1, but tax under part 4. 38 1/3%, which is higher than I would have paid personally. Burn. Please crack open the act to section 186. We've been here before briefly. We talked a little about connected corporations and such. We're going to go through that as well today. Want to take it from a different standpoint, which is dividend received, tax on taxable dividend, not capital, received by my private corporation. Every corporation that is at any time in taxation, your private corporation, shall, on or before its balance due date, pay a tax under this part 4, 38 1/3% of all assessable dividends received from corporations other than corporations connected with it. You can assume for the time being that my corporation is not connected with Shopify. My corporation is just a very minor shareholder of Shopify. It doesn't have any connection with Shopify. So my corporation is going to pay 30 1/3%, about which I'm pretty unhappy. $3,833. If I had paid tax on this myself, I would have only paid $3,500. A couple of years later, I decide I need cash. My company has done nothing else since then. It's sitting on $6,167. I think that's right. Now we need to know what the tax consequences are. First consequence is that all of this 3833 Part 1 tax paid went into the RDTOH, the same RDTOH thing as we talked about before with SIB income. The same RDTOH thing. Therefore it gets filled by two things. SIB income times 30 2/3%. I think I got that one right. And all Part 4 tax paid, 100% of it. Not 30 2/3% of it, not 38 1/3%. 100% of Part 4 tax goes into it. And knowing that I've got a $3,833 refund available to the corporation, and knowing that I've got $6,167 worth of cash, I, as the shareholder and director, caused the corporation to pay me a $10,000 dividend. And the corporation gets a dividend refund of the lesser of $10,000 times 38 1/3%, which is 3833. And 100% of what's ever in the RD2H box, dividend refund of 3833. I now have a $10,000 taxable dividend on which I have to pay personally 35% tax. So kind of at the end of the day, my corporation had to pay some money, it got the money back. Honestly, it probably would have been just as smart for me to own these shares of Shopify personally. There is no advantage. In fact, there's a, depending on the province, a 3% disadvantage. 35% versus 38 and a 30%. You okay so far? And honest to goodness, it's the same RDTOH company. It might have got filled, if this company had SIB income or taxable capital gains, it might have got filled up separately by other SIB or AII in the same year or other years. And the same RDTOH gets worked in to figure out how much my dividend refund is. At one point, tax rates on eligible dividends were a little bit lower. They were more on the order of 30%. Now 35. At the time when they were 30, and the Department of Finance wanting to create a bit of a penalty for investing in corporations via a corporation versus personally, they came up with the nice round Part 4 tax rate of 33 1/3%. $33 1/3 came out because it was just, well, let's just make it a third, 33 1/3% versus the 30% that I would have paid if I had earned the dividend personally. You okay with that? That went on for decades, and then about 5 years ago, the top personal rate of tax got increased by exactly 5.00%. Which is how we got to 38 1/3. That's the story of it. It's interesting to me. It's not at all needed for you to explain back to me in an exam, but a couple of students asked me where 38 1/3 came from. History is it used to be this, and more recently got changed to this because this got jacked up by 5%. That's the total story. Any questions on Part 4 tax and RDTOH as it relates to Part 4 tax in addition to how it relates to refundable Part 1 tax? Moving on. Well, kind of a similar scenario, except now instead of owning public corporations, my corporation, which I'll now refer to as a holding company, Holdco. Holding company is simply a corporation that we use to own shares of other corporations. Actually, I'm going to go back and use Shopify as an example. And again, my corporation owns just a small sliver of Shopify. And my corporation also happens to own a CCPC. It owns 9% of the shares of a CCPC. Each company pays to my holdco a $10,000 dividend. This one results in a 38 1/3% Part 4 tax. And the question is, how much tax is payable on this dividend? And to know that, I need to know whether that CCPC is connected. Because Part 4 tax is 38 1/3% of all assessable dividends, which are taxable dividends, received from corporations other than payer corporations connected with my corporation. So is this connected? If it is not connected, and by the way, it is not, then the Part 4 tax is also 3833, because it's a corporation other than which, or my corporation is other than payer corporation connected with my corporation. I'm telling you, it is not connected. So its status, as far as this company is concerned, is the same status as Shopify. Shopify, in case you don't know, is a public corporation headquartered in Ottawa. They produce a lot of software back-end for retailers across the world, actually. Public corporation. $186.4, for the purpose of this part, which is Part 4, a payer corporation is connected with a particular corporation. So the payer corporation is connected with my holdco. If at any time in the year the payer corporation is controlled, I don't think so, not at 9%, by the particular corporation, or the particular corporation owned at that time more than 10%, which 9% is not, more than 10% of the issued share capital having full voting rights, and is a really important word in the Income Tax Act, as you may know, and from reading other statute, means that both of these have to apply. And shares of the capital stock of the payer corporation having a fair market value of more than 10% of the fair market value of all the issued shares. No, we're still at less than 10%. The shorthand for that test is we're connected if this corporation owns more than 10% of the votes in value. Votes in value. Symbol for greater than. Greater than. Not at least, greater than 10% of the votes in value. If you answer an exam question, votes in value, totally happy with that. It's shorthand that professionals use to describe this situation as to whether we're connected. So if a corporation owns more than 10% of the votes in value. Now, I'm not one to be tricky to say, okay, this is 10%, which requires you to have a trip back to the Income Tax Act, because is it at least 10% or more than 10%? Your questions will either be 9% or 11% or 60% or something. Greater than, but it's greater than 10% of the votes in value. Yes?
And we'll never have to figure out like anything about votes, like we'll never have to figure out votes in value. You would just tell us that amount. Yeah.
I'll just give you a percentage. You can assume that the percentage is both the percentage votes and value. So 9% not connected, 23% connected. Not connected, treated just like this. Part 4 tax, 30 and a third %. See you at 5 after 3.